Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. All right, so inflation is still pretty high. We've had two a little bit lower than expected reports the past couple of months. Markets generally reacted favorably to those, although we're seeing some downside post-Fed meeting. But how do we get down to that 4 or 5%? Well, let's talk about the path of how we get there. Number two, still a lot of unfilled jobs. Some indicators talking about an economic slowdown, jobs market not showing it that much yet. And finally, it's some interesting stats around the free money area, right? 2014, 2015, up until the Fed started moving rates higher here recently. Talk about this era, what that meant, what it might mean going forward, the fact that some of that free money is no longer here. Okay, so how do we get below 4% inflation? We've been up 7-8% here over recent months, right? We're at 40-year highs. How do we start to get moved lower? Well, it's actually not that complicated. It's simple math. If we look at the trend of what's been happening the past 5 months, we've seen inflation range from 0% all the way up to 0.4%, but it's been below that 0.4% month over month gain for the past 5 months, right? If we just stay on track for that, right? Somewhere between that 0.2, 0.4%, 0.35 is the long-term moving average or the longer-term average monthly gain. Look at that. By April, May, June, we could be below that 4% inflation. We have seen improvements in the supply chain, which has been the major driver of inflation during this part of the inflationary cycle. I really believe it started with the demand side with the historic amount of monetary and fiscal policy, passed the baton to supply side. That's improving, which could be inflation down below 4% by next summer. So the labor market, economic indicators, a lot of them talking about a slowdown in 2023. Well, you're going to have to see unemployment jump up significantly for it to be a steep recession, right? A prolonged recession like we saw during the financial crisis or even the technology bubble, right? Is that going to happen? Well, take a look at this. These are the number of job openings, still at a very historically high number. We started to see them come down, right? These job openings are starting to come down, but the fact that there's so many job openings still out there, are companies going to just stop posting jobs before they actually lay off people, right? We never had the big boom in employment, so maybe we don't have as large of a spike in unemployment during the economic slowdown next year. And finally, let's talk a little bit about the end of the quote unquote free money area. This is a chart that shows the percentage of global bonds that were yielding negative debt, right? It's kind of tough to imagine what that is, but basically interest rates have been 0 or below for a lot more countries than they ever have been in history. And it started back in late 2014, early 2015. We saw during this phase, growth equities outperform, stocks have performed wonderfully. Any sort of downturn in the market has been met with interest rate cutting excessively back down to 0% and markets rebounding with V bottoms, right? So growth, risk on assets. Well, take a look at the chart. Japan's sort of the lone cowboy left, but it's pretty much over. The free money era is over for the time being. So we have to adjust our thinking about what that means for equities and asset classes going forward. And one of the things it means is all of a sudden stocks do have competition, right? There is income in fixed income again, right? Yield is back in 2023. And so this is a look at the percentage of stocks, and the dark line is the stock 600 US index. The S&P 500 is the lighter blue. That's the US equity market indexes. Both of them have gone down significantly, but take a look at specifically on the US side, the percentage of S&P 500 stocks that have dividend yields that are greater than the investment grade yield. So investment grade corporate bonds, the average yield of those versus dividend yields of stocks, less than 5% of stocks have dividend yields greater than the investment grade yields. So stocks don't look as favorable relative to bonds. All of a sudden, there's a choice for investors in the marketplace. That wasn't the case for the past several years, as we talked about. With that, I want to thank everyone for watching. But before that, leave you with always our fun, interesting news, factoid, whatnot. This time it's the Oxford Languages, right? The creator of the famous dictionary has named quote unquote goblin mode as the 2022 word of the year. So congratulations to you, goblin mode, number one. Number two, a couple takeaways for me. Number one, never heard of it. So it's kind of a reminder that I'm not really cool anymore, right? I don't think I'm young anymore because I've never even heard somebody talk about this. Apparently it means you're lazy, you're not doing anything, you're just in full devouring of just eating chips, watching Netflix, just full on not caring about societal norms of discipline or goals or anything like that, right? You're in full on goblin mode of excess nothingness, apparently, okay? So never heard of it, not sure about it. My last thought, isn't that 2 words? Or am I just old-fashioned? Goblin mode with a space between it. I thought that was considered 2 words, but what do I know? All right. So with that, I want to thank everyone for watching, and I'll see you next time.